Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep. With your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to PreMarket Prep. Spencer Israel, Dennis Dick. A lot to get to on today's show. The reopening trade is back on. Thank you very much, Moderna. Thank you very much, AstraZeneca. We'll talk about those two headlines, and really it's just a repeat of what we've been talking about for, I don't know, weeks, maybe months at this point. But every time we get new COVID vaccine news, the market loves it, and people just trample over themselves trying to buy. You're seeing that happen again this morning. The market's up, reopening stocks up, airlines, casinos, retail, you name it, up on those vaccine headlines. So we'll talk about that. Apple got some good news out of the European Union court. They don't have to pay $15 billion in back taxes. We'll talk about that. Earnings this morning, Goldman Sachs, UNH, Netflix reports tomorrow. We'll talk about that as well. And our guest today is David Traynor. He is the founder and CEO of New Constructs. He will join us at 8:35, and he does a really good earnings analysis, like macro earnings analysis, and talks about what to look for in earnings reports and why expectations may be out of line with reality. So that'll be at 8:35. Before I bring Dennis on, I want to tell people that we've been trying to post some highlights from the show. If you hop into the community section of our YouTube channel, so youtube.com/BenzingaTV, and there's a little community tab. We've been posting highlights or trying to of that. So check that out if you can. I think that's my spiel. Dennis, good morning.
What's going on?
A lot is going on today, actually. Funny you ask.
Can't stop, won't stop. That's this bull train. It will not stop, and it will find the reasons. And obviously, we said this on Monday. If we're going to pop 300 to 400 points every time we get some positive news on a drug trial, this Dow is going to be at 35,000 or 40,000 by the end of the year, because we don't go down on the bad news, or we go slightly down, just from technical reasons. And then a headline on a vaccine just takes us right higher again. And that's what we saw Monday. It's Groundhog Day here again on Wednesday. What stocks are going to go up today? You know what stocks are going to go up today. It's all the stocks, the trash stocks. Boeing, retail, cruise lines, airlines. That is what they're going to pile into this morning, and they are piling into since 5:15 last night, when Moderna came out and gave some positive news. What was that news, Mr. Israel?
Here's the money quote from the press release. Their vaccine showed, quote, immune responses in all participants, and no trial limiting safety concerns were identified. These findings support further development of this vaccine.
I mean, so it's good news. It's good news. Moderna shareholders being rewarded. Should the S&Ps be popping through, 30 handles every time we get positive news? That's what it does. I mean, so I don't know if it's justified, if it's not justified, but you can't worry about what's justified and what's not justified. You got to worry what's in front of you. And if you're short this market, again, it's very difficult, because here you are, you have life yesterday morning, S&Ps, well, actually life yesterday late morning, because we started to roll over and it looked like, oh, this could get ugly. And then we just start to go up a little bit in the afternoon. We start to have the buy the dippers come in, and then every long bailed out once again from the Moderna headline. But not only that, we had a positive headline from AstraZeneca too on the vaccine front. So the double good stuff there. What a zebra and say, because they are trading up 4% in the pre-market as well.
Yeah, this one's less official. The Moderna thing was a press release. It was an announcement from the company. This is a report from a British outlet, and he said that his report is going to be replicated in the Lancet, which is one of the oldest and most well-known medical journals in the world. But the report is that the Oxford COVID-19 vaccine that AstraZeneca is backing is generating the kind of response that researchers want and would lead to further studies. So there's going to be a phase 3 study, or actually they're underway with their phase 3 study in Brazil. but it got some love from this British outlet, and he said that the Lancet, which is this old journal, is going to talk about the efficacy of this vaccine here shortly. So positive.
Vaccine. Just like we said Monday, it's the trade deal all over again. So, well, we got a deal. Oh, we don't got a deal. Oh, we got a vaccine. Oh, well, we don't quite have a vaccine, but we're going to get a vaccine. I think there's going to be 100 headlines like this in the next 6 months. We got 2 in the last 3 days. So there's so many companies working on this. I mean, and if they get a disappointment, is the market going to sell off 30 points or 40 handles? Probably not, because on the trade deal, we'd rally. Oh, we got a deal. We'd rally 30 handles on the S&P, and then we don't have a deal. We'll sell off 10. And then we'll rally 30 and we'll sell off 10. Mm-hmm. We can do that math pretty quickly. 3 steps forward, 1 step back. You just keep stepping forward. So I do not want to be short this market. I am a buy on the dips. I added some more risk to my portfolio yesterday on the pullback, which obviously was a good thing. I added to my LCA. I've bought that 3 times now. I really believe in that stock. It's in the long-term portfolio though, but I was adding some other stocks too, just on the dip, just allocating capital there, because what do? We buy the dip and sell the rip, and we got a hell of a dip there yesterday. So I took that opportunity to start adding some stocks to my long-term portfolio. I don't know if I should sell them out here right away, because we just rallied 100 S&P points since 10:30 yesterday morning. It's an incredible rally. So if you come in here buying it now, again, you're doing it backwards. Buy the dip, sell the rip. It's not buy the rip, sell the dip. So you're selling yesterday, you're doing it wrong. You're selling today, you're doing it right. With that being said, I think the all-time highs, the way the market just shrugs off the new cases, the deaths are not climbing substantially yet.
They're not.
You can't, and then we got the vaccine trump card. So you can see a lot of reasons why this market just wants to go to new all-time highs. So maybe it's back on the table.
And I saw a newer listener in the YouTube chat earlier. And so biggest thing is we're just trying to teach you how to think a little bit. So think about good vaccine news. The market interprets that as we're good to go, essentially. So think about every company, every stock affected by the shutdown: retail, cruise, tourism, travel,
those are the stocks.
Lodging. All of those stocks trade together, and they're all trading higher this morning. The hotels, Dave & Buster's, the casinos, the airlines, every business affected negatively by this crisis is going to see a pop today. Every one of them, unless they have news about that specific company that happens to be bad. But pretty much across the board, you're going to see rallies today in all of those stocks.
Oh, that's what you're seeing already here this morning. Those are the leaders. I'm bring up your Carnival Cruise Lines. It's up 8%. Your Norwegian Cruise Lines, it's up 7.5%. Your American Airlines is up 8.5%. Boeing, a little bit, bigger stock, higher price, less beta than American Airlines. It's still up 3.5% here this morning. House of Mouse, it doesn't matter about the reopening of the parks, but the reopening potential of the economy from a vaccine does matter. And it's up 2.9% here this morning. So it's clear, those are the stocks. So if you're wondering, you come in this morning, you're like, why is Netflix down $6? Netflix doesn't want a vaccine. Netflix, I'm not saying the company doesn't, but the stock itself wants everybody to stay at home forever and just keep watching Netflix. So there's lockdown plays and there's reopening plays. The lockdown plays are likely to have rotation coming out of them today. So I had Josh from Twitter. He wanted to just talk Netflix, so I can just talk technically on it just for a quick second. But bottom line here is it's going to show weakness here because there's vaccine news. So when there's vaccine headline breaking, it equals sell Netflix, it equals sell Amazon, it equals sell Shopify, it equals sell the video games, it equals buy Boeing, it equals buy airlines, cruise lines, retail, and restaurants. So, and the rotation is very, very clear here this morning. You can see the Qs only up 0.26%. Why? Because technology works in any environment. It's not going to benefit directly from the vaccine. Yes, a little bit, but nothing like, the IWM components, which is up 2.83% here today. So today, IWM value investing, reopening plays are winning over the NASDAQ. If you look, Amazon obviously trading down 24 points here this morning. Again, people think, hey, the economy reopens, we're going to go out, we're not going to buy as many things from Amazon. I think they're buying stuff from Amazon no matter what. I'm in Amazon already, but I think weakness on some of these, companies that just rock in all environments is probably a buying opportunity. But maybe it shakes out for a couple of days. We'll see what happens. Amazon obviously had the key reversal there 2 days ago, so it's a little bit out of favor for now when everybody just had to get in and pile in at 3,300. Then it fell under 3,000. So let's see if yesterday's low holds in Amazon, and that's 29.50.
And actually, Moderna headline, vaccine headline notwithstanding, we've seen a weak couple of days here for the if you want to call it the work from home trade, right? Stocks like Slack and Zoom and Team.
Yeah.
And you can even play there's a new ETF, WFH, work from home. That trade has been off for the past couple of days, and it's going to be off again today.
Yeah. And, we talked work. We've talked, and there's a huge support level in work at $30. I had it. I bought it at 30.5 there. I sold it a couple days ago when I started seeing the rotation start to come out of those names. I sold it just basically in that you can see that where it spiked up to over $36, but it looked like, so they were starting to reverse, and that's when I sold my work. So that was a swing trade. I'm out of it. Gets back down to 30. Maybe I take another shot. So we'll see. It's down 10 cents here today. Could show some weakness because it's a lockdown play. It's a COVID play. It's not a reopening play. So huge support at 30. If it gets down there, I'll probably take another shot at it.
Yeah. So that's the story of the day. That's the theme of the day. Reopening trade, hot. Work from home, stayed home trade, not. Is as Dennis said, the video game stocks, your software, your work from home software like Slack and Zoom, Netflix, anything that you've been leaning on heavily while stuck in quarantine, any stock is not going to be up today.
You've got to understand these rotations. If you're a day trader, if you're a long-term investor, you should understand it too, because if you're coming in and buying stocks like Netflix last night on this, it's a selling opportunity because they're probably going to get hit. I know last night some of these stocks initially traded up because they're like, oh, the S&Ps are going, you got to buy everything. You got dumb algos out there, just buy everything. And then, a few minutes later, you start to see the separation start forming. That separation isn't immediate because the algos aren't programmed for it yet. They're slow. Yes, algo trading is out there. Yes, they're good at their market making. Yes, but they're not good at new relationships. They take a long time to program them all in and figure them all out. And they're not pure. I mean, they bounce around, these relationships. Obviously, we're not going to be talking COVID relationships 2 years from now. At least I hope we're not still talking COVID 2 years from now. I hope we're not. If we are, we're going to be talking a lot of bankruptcy on companies too if we're still worrying about COVID in 2 years.
Yeah.
But you've got to understand these rotations, and that's what we try to bring you on the show. I mean, there's a lot of shows out there that talk technicals. There's a lot of shows out there that talk fundamentals. We try to bring all of that, but we also try to bring you the relationship trade. It's something Bright Trading, StockTrain.com is specialized in for 25 years. And there's a reason why our traders make money. A lot of our traders make money every single year, and a lot of them, like myself, every single month, because we're exploiting those little relationships that other people aren't exploiting. So if they want to just buy something up last night, like even, you can look at, a stock like Livongo Health, for instance. LVGO catches some love from Credit Suisse here this morning. Also catches some love from Mad Money this morning. It's trading up 2.5%. I'd ring the register on this for the simple reason that this is a reopening play. And they're buying it this morning because CS comes out with a price target raise. And, and it's a big one. And Jim Cramer gave it a whole bunch of love last night on Mad Money. It's trading almost 106 last night, so it's already leaked off those highs. 104 here right now. This is a classic reopening stock. So there's if you're just following the relationships here, it says sell LVGO this morning when it's spiking up. So can, Cramer and can Credit Suisse overpower the reopening? Maybe, but I bet on the reopening play, and that equals sell on these lockdown stocks more so than I bet on Cramer's pump and CS's pump.
One thing I have not looked at, look at it now, is the relationship that vaccine stocks have to other vaccine stocks. So Monday we got BNTX and Pfizer with news. Today we have Moderna and AZN with news. How are Pfizer? I guess they're trading with the rest of the market, right? Pfizer and BNTX are up. They're on their own vaccine, and they had good news 2 days ago, but I guess they're just correlated with the rest of the market. But
Which stock you looking at?
BNTX and Pfizer, just the stocks that had the good news on Monday. The vaccine.
I mean, that's yesterday's news, right?
Right.
So it's yesterday's
they're
news.
still trading up. So I guess is my point. They're just going to trade.
We're seeing a lot in, again, the rotation into value a little bit too here this morning. Spencer probably helps a stock like Pfizer. It's helping the IBB. It's helping the XBI. It's basically, you've got those two, obviously, the two plays going head to head with each other. You've got the value play and the growth play. And it seems like you get very few days that both are in favor. You get very few days that both are out of favor. It's like rotating to growth or rotating to value. When you get the vaccine, they rotate into the value. When you don't have vaccine news, they start to rotate back into the growth. So if you're in these growth stocks today, they're probably going to underperform. I mean, the Qs are only up 0.36%. So Pfizer up 1.6%. I'm not surprised. Money rotates, even though, you could see Moderna as a competing play. Pfizer's a value stock, and money is looking at value here today. Warren Buffett would be smiling today, and his stock is trading up 2%. Value is in favor, at least this morning. And these rotations change. I mean, yesterday, and somebody's pointing out, you were saying to sell into this rally. Yeah, I was. Yesterday's rally was to be sold into, in my opinion. We were trading up. Actually, we were trading up almost. Where were we yesterday morning when I was talking about that? 315, 316. And we sold off after that. And then we started to catch a bit. But what I was talking about, I don't think I was really talking S&Ps to be sold. No. I was specifically talking Tesla. I was specifically talking Apple. I was specifically talking stocks that were rallying in the morning, the tech plays. And the tech really got hit after that. It came back because the buy the dippers come back, but I've got to, it's difficult. Maybe I should have an investor hat, maybe I should have a trading hat. I'm a trader. I'm talking trades for the most part. Like, what am I doing here at the open? What am I doing, in Tesla? I mean, Tesla, I was like saying, yeah, I would sell the rip up in Tesla. I was 100 points higher. Stock was trading 1602 when I was saying that. Yesterday, it opened around, it opened actually a lot lower than that, but it was trading 1602 in the pre-market. It went all the way down to $1,431. So you're talking about a 170 point fall after I said I would sell that rip into Tesla. Here we get the rip in the market, and Tesla's still not back to that 1602. So be careful, when you're listening. Don't just take, sell in your portfolio, buy in your portfolio. If you're a long-term investor, you need to, have, stronger hands. You're not buying and selling your stocks every single day. Mm-hmm. So I'm talking to the day traders. I'm talking to the short-term investors. When I'm talking to the long-term investors, we know in my long-term investment account, I've said I've been in a lot of cash. It's been wrong. I've been very wrong from a long-term investing standpoint because obviously we've rallied significantly from the lows, and I did not account for the fact that they're going to rally every time we get any positive headline. They find the silver lining and everything, but that's what this market is doing. So my long-term portfolio, I'd be buying dips, but as traders, I'm buying dips and selling rips. Today, I'm probably taking profits if I bought stocks yesterday.
One more thing on this Moderna news. If this is your bag, the registration for the trial begins on the 21st, and the initiation of the trial is the 27th. So if that's your bag, we wondered how people get in these vaccine trials. So if one of you is into that, I guess let us know because I'd be curious to find out. But should we go to the banks here, Dennis? Because we do have some more bank earnings today. Maybe we should talk about the follow through in Wells, JP Morgan, and Citi yesterday, and then go to Goldman here this morning. But Wells Fargo was able to come back. Citigroup not so much, but Wells Fargo was able to come back and actually traded higher in the after-hour session. So
a lot of bad news baked in here. We knew about the dividend. We've got some major support. We talked about the support around 23.71. It did breach that, but then got back above it. You had the 22s in Wells Fargo to lean on from back in May. So you're coming into where you have still an area of a lot of support. So it's going to take some serious bad news to knock Wells Fargo down here and now. And it was serious bad news yesterday. Yep. And obviously the stock went down significantly, but I think it's backing and filling now. I'd actually be a buyer of Wells on a pullback here just because right now there's, obviously the potential here where we've got some vaccines coming. There's so many vaccines cooking. I mean, vaccine changes everything. So I'm buying dips if I get dips. I'm not coming here and buying stocks today though. Again, you're coming in and buying them when they're, chasing them up here. You're doing it backwards. I'm just going to keep saying, buy the dips and sell the rips. People saying I'm wrong 90% of the time. I don't know. I make money almost every single day, so I can't be wrong 90% of the time. But even if I'm wrong, let's say 60% of the time, it's about discipline. It's about cutting those losers and, admitting when you're wrong. And you can be wrong. I've seen some great traders be wrong more than they're right, and they still make money every single month. And how do they do that? Because they cut their losers and they let their winners run. So their winners are just a hell of a lot bigger than their losers. So it's okay to be wrong. Don't think, as a trader, you're going to be right 100% of the time. It's totally okay to be wrong. I have no idea when I'm right, how much I'm right, how much I'm wrong. I feel like I'm right more than I'm wrong. Maybe I'm not. But I'll tell you, I make money. I've had now since 1999. You can, this is, if regulators are listening, I have the records to prove it. In my Bright Trading account, I have made money every single month since 1999. Not one losing month since 1999. So I think I'm doing okay.
You should, when hockey comes back, what you should do is you should plot your P&L against the Oilers record.
Well, the Oilers are a different story here, Spencer. The Oilers never seem to do that okay. So,
so do you know who?
I don't want to talk hockey. We're hoping this year is going to be different, but I'm scared of the Blackhawks too. So I hope we're going to get hockey. I hope we're not going to get to a point, because a lot of people, a lot of players, it looks like, who potentially have COVID. Yeah. And I hope it doesn't get to a point where they just start to, this may not work. I hope it works. I want to see hockey again, but I don't want to go on a hockey tangent.
Do you know who else has been making some good trades? The people at Goldman Sachs have been making some good trades.
Exactly. And this is what we talked about. Did we talk about this yesterday on the show? I think we did.
We did, yes.
We specifically said yesterday on the show, and it's somewhere on the tape yesterday, but we talked about Wells Fargo versus JP Morgan. What was the difference? JP Morgan's got some heavy trading operations, but nothing like Goldman. Goldman's got big trading operations. So I said yesterday on the show, I said, I almost want to be long Goldman going into the report. I took Goldman Sachs home long in the intentions that I might go through, but then it got bid up after hours so much, and it was up so much ahead of the report that I was like, I'm just going to take the, the sound. I just sold it, after hours last night. And obviously it's up way more than that now.
Classic, Dennis.
But yeah, so I should have held anyways, but I took the quick buck and I didn't have to take it through the report. And it's obviously up significantly. Why? Because their trading side's killing it. Break down the report for us, Spencer.
Yeah, I don't really know how comparable these numbers are to the estimates, but I'll read them nonetheless. Q2 EPS $6.26 versus a $3.78 estimate. Sales 13.3 versus $9.7 billion. Here's where they made their money. Global markets revenue up 93% on a year-over-year basis. That segment accounts for 54% of their overall revenue. That's their trading. That's their equity, fixed income, commodity, and currency trading operations. So revenue for that segment up, 96%, 93% year over year. Investment banking revenue up 36%. So just massive trading revenues.
Volatility goes up. Traders make more money. My profits have nothing to do with whether the market is going up or down. It has everything to do with what is the VIX doing. VIX is higher. Traders who are doing market making, arbitrage, statistical arbitrage, headline trading, any type of, traders that are basically trading off of inefficiencies make more money when the VIX goes higher. Your high frequency traders, Citadel isn't sitting there and thinking, oh, I think, I like the chart on this stock and I think it's going higher. So I'm going to take, I'm going to take a flyer here and put, 10% of Citadel's net worth into this one stock. They're not doing that. You know what they're doing? They're taking advantage of the inefficiencies. They're making markets. That's where they're making the most money at all. They're making markets. So they're on the bid and they're on the offer. When you have trading volumes up higher, there's more traders transacting on the bid and transacting on the offer, and they're making more spreads. And the spreads, when the VIX goes higher, the spread goes wider. So that's where they're making the money. So as the VIX goes higher, anyone who has significant trading operations, like professional trading operations, typically makes more money. That's why I make more money. That's why Virtue Financial makes more money in these markets. That's why Citadel is likely making more money in these markets, although they're private, but we know they're killing it. And that's why JP Morgan did well on the trading side. And that's why predictably yesterday, which we said, Goldman Sachs is likely going to kill it on the trading side. And they absolutely did.
All right.
So it's up $8 for that.
Yep. Stock up. What is the here? So 4% this morning. We're at just about 223. I'll just pull up a daily. We can kind of get a feel for this one longer term. So still not all the way back, but for the banks, I mean, Goldman Sachs is your leader, JP Morgan is your leader. So those are going to lead here. But yeah,
the banks are going to be back into favor. And now the people are scrambling, looking, oh, what other, well, we've kind of got, so we got Morgan Stanley coming yet. They have significant trading operations too.
Yep.
So when does Morgan report?
That's tomorrow.
It's already up 3%. So now the question is the bar set too high for Morgan Stanley? Coming in buying it up 52, maybe it even hits 53. It's breaking out. The bar is set higher, unfortunately for, if you're just looking at it just from that perspective. But in any regards here, trading, I just want, traders to realize, that it's different in the professional world. Like I've always said, I don't make money. The majority of my money isn't making calls and what I think. The majority of my money is made by trading and exploiting market inefficiencies. And there is a ton of them out there when the VIX explodes. I mean, the VIX is 20. When the VIX is trading 70, 80, it's just inefficiencies all over the place. There's bloody margin calls happening. So, there's stocks that are being forced sold. Yeah. So when you're getting stuff that's forced sold, and there's still reasons for being there, you find, you buy that and you find a stock with similar and you short against it. I still, like I said, I trade market neutral. I'm always exploiting those market inefficiencies. If you want to learn more about that type of stuff, I would suggest looking at stocktrading.com and looking at Bright Trading. If you want to, continue, and the majority of traders that listen to the show are looking for swings. And that's why I try to make some calls on this show. And I try to play these, I try to do some of this stuff with you guys, like LCA, I've been making a long-term investment call there. Not a trade, not a day trade, not a swing trade. I stuck it in the retirement account because I believe that the valuation is attractive. I believe there's a story here going forward. That's, the recent one. When I add something to the long-term portfolio, I typically tell you guys, because that stuff, I feel like, and sometimes they're good, sometimes they're bad. But I feel like that's stuff that, other people, might want to participate in. It's hard for me to talk stat herb with you on this show. I talk it a little bit there, but those trades are so fast, you're in and out. I mean, there's not that much opportunity like for me to just say, oh yeah, quickly, hey, look at this opportunity. They don't exist for very long. Those opportunities typically only last a few seconds. I mean, last night on Moderna, the way I was playing it, I'm buying the reopening stocks and I'm selling those tech stocks. And, if you just flat out on the MRWM headline, bought IWM and shorted QQQ, you probably would have some slippage. But as of right now, you'd be up 2.2%. That's the play. That was the play. And last night, you probably could have put it on for maybe, 0.5%, 0.7%. So, you'd still probably possibly be up 1.5%, even if you were late to the party. That's the play. That's how you play those things if you're a trader.
You want to do UNH earnings? Is that on your radar?
Yeah, let's do them. Let's fly through the earnings here. Sure.
I mean, they're in the Dow, aren't they? They're pretty notable.
Oh yeah, for sure.
Q2 EPS $7.12 for UNH versus a $5.15 estimate. Revenues $62.14 billion versus a $63.4 billion estimate. So they missed on the revenue by a hair, beat on their EPS estimate for whatever those estimates are even worth. I'll pull the pre-market chart up here so you can see. It doesn't trade much in the pre-market.
So UNH, it was a good report. It had run up a little bit into it yesterday. The revenue missed is the problem, right? Mm-hmm. So the bottom line beat, but the revenue missed.
Yep.
I mean, that's a mixed report, really. So I shouldn't say it's a good report. So it's hanging out here. It doesn't know what to do. It's traded 47,000 shares. It's just chopped around a little bit here. So you're going to have to wait till the market opens, digest it. I'd say if you're in it, 315 is major resistance there. If it pulls back to yesterday's low around 300, buy the dippers will emerge. UNH is a love company. I think if this pulls back $8 to $10, it'll find love again. So again, on earnings, the way I'm approaching this earnings season, if you've got companies that you really like and they miss for whatever reason because it's going to be an ugly quarter, maybe those are the ones you nibble into. Last earnings season, I did that in Target. It worked out really well. I did a number of stocks. CyberArk, that one worked out as well. So CYBR, after the earnings missed last quarter, you can see the big fall. I bought around $96, back to 107. Just basically buying the dip on the disappointing earnings. I mean, Facebook, if you're buying on that headline there a couple weeks ago there, obviously with all the political stuff going on and the headlines, and obviously, it fell off significantly, but it came back 3 days later. So buy good companies on dips. Always works. UNH is a good company. If that was to fall $10, I'm not saying it's going to, but I'm saying if it did, I'd be a buyer down there.
And we're going to talk earnings sentiment, earnings expectations with our guest here in 5 minutes, David Traynor. He's the founder and CEO of New Constructs. Between now and then, let's look at Apple here. Big headline, big win, big legal win for Apple here overnight. They do not have to pay that massive fine, that record fine, $15 billion in back taxes from Ireland. That's per the EU's general court. So the EU itself might appeal, but for now, that's good news for Apple. They're going to save $15 billion.
I would not buy Apple up here. I own it in the long-term portfolio, not getting rid of it. So if you've had it for a decade, hold on to it like I am. $400 is a huge number for it. It got up to $399.82 and then quickly rejected it, went down. You got some people who are caught a little bit in this. They're getting their money back here this morning. The NASDAQ, again, I don't think is going to be your leader here today, as long as with the vaccine and obviously keep Boeing up and keep those reopening stocks up. But as long as that rotation doesn't turn the other way, I think Apple actually would be faded here. So I'd be a fader of the 6-point rally in Apple for the simple reason it's not a reopening play. Speaking of reopening this morning.
Speaking of Boeing, actually, the power of the reopening trade is strong enough to outweigh the fact that they report another like 60 cancellations for them. I saw Phil LeBeau was breaking down the numbers on CNBC yesterday, but they reported just a massive order deficit for the month and for the quarter. But it doesn't matter, right? Reopening.
None of that matters if a vaccine comes too. I mean, the market is pricing that, hey, we might get a vaccine. We got all these companies. Let's think about the market. What the market is thinking. We have all these, pharmaceutical companies working on the same problem, working on a vaccine. We keep getting positive headlines. Eventually, somebody's going to hit. And you know what? If the vaccines actually work and all of a sudden they don't have to worry about COVID as much, people will fly more, people will, and so they're going to pile back into these stocks. With that being said, part of this business model of airlines is going to change just for the reasons that the Delta airline CEO, when he was on CNBC a few days ago, I believe it was the Delta one, was talking. I mean, consumer habits are somewhat changing. The business travel might not happen as much as it used to. So I don't think even with a vaccine that the airlines are getting back to the profits that they were making. And that's not good news for Boeing. So I don't think Boeing's going back to $300 and $350 anytime soon. But in this market, you never know anything. But if the vaccine comes, Boeing could quickly we all of a sudden we get, yes, this vaccine works. This is finalized. We're going to start, Boeing, all these stocks will be significantly higher. Mm-hmm. But they're going to go up so much in incremental increments before that, positive vaccine headline, they pop $6. But we're still going to get lots of positive vaccine headlines. So I'd say trade them on these headlines. You see the headline, it's the stocks you're trying to pile into, 30 seconds a minute after those headlines. You see the headline, break the other way and it's disappointing vaccine news, they come out of these. It's just clear rotation here this morning. And the rotation is identical to Monday into the reopening stocks and basically out of tech.
How would you approach Bank of America here? They report with Morgan tomorrow.
Bars, well, they don't have as much trading operations. So they all have some,
but
not like a Goldman or a Morgan. So bars a little higher. It's up 24.80 here, so it could hit 25. It's not like Goldman seemed like an easy call because the stock hadn't really run up yet. It was at 214 and it ran up a little bit, but it just seemed like an easier call. At JP Morgan kill on trading, we know Virtu would kill it on trading. I know in my own portfolio I've been killing it on the trading side. It just seemed like an easy call that Goldman was probably gonna make a lot of money because of the trading side. It's not that easy for Bank of America. Yes, they've got some, but it's not like Goldman. So I think it's a curveball. I don't know how to play that one.
Tough one.
I'm out.
Yeah,
not trading it.
And it's a curveball, and for that reason, you're out, right?
Yeah, I swing at pitches up the middle. That's why I make money consistently too. I'm never swinging at, I think this might go this. I'm going with like when the ducks are in a row. I like the technical setup. I like the story. I like where the market's going. I want those three ducks. I want the market in my favor, first of all, because I'm not buying anything. The market's tanking. I mean, yes, buy the dip, sell the rip. But I mean, at that moment in time, if I think the market is going to tank, I'm not going to buy a stock. So I want to first be thinking that the market is going to go higher. Secondly, I want, usually a story or at least a stock trending up that's, in favor. And then third, obviously I want, often a catalyst, like something on, a story or something with it. And I want the technical setup as well. I want it to look like, hey, this looks okay. Like work, when I bought Slack, a week and a half ago for a swing trade just above 30, I was like, well, I got major support here. So I have a technical setup, and some of the, the lockdown stocks were starting to show life again. And then work started to show life too for a few days. Now that's broken. But, now I looked at, the stocks that are getting thrown out today are going to be those lockdown stocks. Those, work sometimes, those work in both environments. So it depends on, obviously what you think the overall market's going to do. But it's been buying the dip and selling the rip so much that today I'm not really looking to buy stocks. I'm looking to sell stocks. And, if we come off and we fell 500 points for whatever reason, because it seems like we always just chop around, then I'll look to buy the dip on those stocks. But today, if you get a dip on some of these stocks that you've wanted in your portfolio, I don't know if I want to jump into a Netflix here. Yes, Netflix is going to trade down. Yes, Netflix got rocked. But it's so, if we get a vaccine and we're coming out of this, lockdown, and we're going to go full reopening, Netflix is crazy expensive. So, does it reprice to where it was 300 when this started? I'm not sure about that. There's a lot of people who maybe try Netflix for the first time and really like it. But is it worth 550 if we're reopening? I don't know about that either. So there's safer places for my money than Netflix.
All right, let's bring our guest on now, David Traynor. He is the founder and CEO of New Constructs. David, good morning.
Good morning. How are you guys?
We're doing okay. David, you have a different way of looking at earnings season. Talk to us about how you look, because when we're on the show, we look at surface level estimate, beat, miss, and then go from there. But you approach things this differently, and talk to us about how you approach it.
Yeah. I was hearing you guys talking. I'm thinking, what we do is a nice complement to exactly what Dennis was talking about. We're not really looking necessarily at headlines or sort of recent trends. We know that there are a lot of folks that are a lot better at that than us. But what we do is complement that by looking sort of beyond skin deep to the scrub numbers. And that's taking into account footnotes and other disclosures that are very important to the overall earnings picture, but are not readily available to investors. They're not in Wall Street numbers. In fact, they're not anywhere else. And this has all been recently proven by a study from Harvard Business School and MIT Sloan. So we've got this technology that gives you a cleaner, better earnings number. And so we like to focus on that, where earnings are understated and overstated. We like to go long or short. It's the longer term trade. It's sort of a safer, more fundamentally driven play. Not nearly as sexy as what Dennis is doing. Buying the dip and selling the rip, but it's an excellent complement to strategies like that.
But there is a number that you can lean on as like the base, right, for this analysis.
Well, I mean, our numbers. So it's a core earnings number. It's a cleaner core earnings number, and the idea is that, especially these days, right, the numbers. Everyone's saying the numbers are a joke because there are going to be so many unusual expenses and issues, COVID related, in the 2Q number. In fact, we saw, even though in the first quarter we only had about maybe a half a month to a month of COVID in those numbers, we saw almost as many write-downs in the 1Q numbers as we did in all of 2019, right? Like 60% as many in just that partial period. So we think in 2Q, we're probably going to maybe see as many write-downs as we did in all of 2019. And for 2020, a huge spike in write-downs. And it's not just because of COVID, it's because businesses like to throw in the kitchen sink when things are bad. In some ways, it's sort of a reflection of what you guys were talking about a minute ago. When sentiment is down, companies know that no matter how good their news is, their stocks won't jump as they will in a positive sentiment or bullish environment. So they clean the books. They write everything down that they can, while things are bad, because they know it's bad. It doesn't really matter if they do anything good, and they want to clean the books for when things get positive again.
All right, so let's talk today, right now. Your thesis is, your argument is that core earnings have actually not fallen. They've diverged from operating earnings, and therefore the picture is not as bleak as many assume. Correct?
No, that's exactly right. And I think that's why we see the whipsaws in the market, right? The sentiment sort of on on a day-to-day basis overplays the news in a lot of ways. I think we'd all agree, right? That the world is not changing as much as the market changes. And so our core earnings number for the first quarter shows around a 2% decline, where Wall Street consensus is showing closer to a 25% decline, right? And so it's a perfect example of how traditional Wall Street consensus and traditional measures of core earnings are misleading.
So I pulled up this chart here. You say don't fall for the fall in legacy operating earnings. So that blue line there is your analysis of core earnings, core priced earnings, right? And the red dashed line is price to operating earnings. Did I get that?
Spencer, that's just the operating earnings. The other chart I sent you shows the price to earnings ratio, and when you use a PE on the bad number versus our number, yeah, you see a lot. It really accentuates the differences. Here, it doesn't seem like that big a deal, except in the recent period. But you go back to 2008, the financial crisis, you're really getting a false signal on the operating, traditional or legacy operating earnings versus our number.
Yeah, here, I'll pull it up there right now so we can see a chart. Going back to the last time we had a major crisis here, operating earnings, our price to core earnings, price to operating earnings. You can see the December 08 there as the market bottomed, early 09. Core earnings fell, operating earnings did not.
Well, no, I think the PE there, this one is the PE chart, right? Okay. So our PE went way lower because our core earnings did not fall as much as the traditional core. Right. So the price reaction really gave you a much clearer buy signal at the bottom. The black line is actually the price of the S&P 500.
So why is there such a divergence here?
Because the core earnings numbers are overly pessimistic and taking into account too many unusual items. So the idea for core numbers and understanding businesses, like we know we're not buying stocks for this quarter's earnings alone. We're looking at the sort of long-term recurring profitability of the business, right? And so when you have a bunch of unusual items like COVID write-downs, asset write-downs, et cetera, the earning gets depressed by one-time items that are not recurring. So if you can strip out the unrecurring stuff and get to the core normalized operating profitability of the business, you're getting a much better proxy for what the market cares about in the medium and long term. And that's why it's a better number to build your analysis around.
And then to take that one step further, how does this compare then to the argument about valuations and we're in a bubble? If you're looking at we're looking at different earnings essentially, right? You're looking at one, everyone else is looking at another. So how does that relate to this argument that valuations are just so overblown?
Well, look, I mean, I think that's for sure true in certain areas, but if you're scrubbing the numbers and looking a little bit deeper, you can still find some great value opportunities. And even if you're just going to resolve yourself to saying, hey, everything is super expensive, at least be in the ones that are not the most overpriced because you're looking at the wrong number, right? So it's always better to have better information. You know, what we do is widely available. And I always tell people, you know, a lot of people have like a step back. So when Harvard Business School wrote a case study on new constructs, their primary quote for me was from meetings I had with institutional investors who said, yeah, David, your data is probably better, but as long as everyone else has the same bad data, we're okay with that.
Isn't that Wall Street in a nutshell? Right?
It totally is.
In a nutshell.
Yeah. And so what I tell people now is that, you know, that sort of made sense back in the day before more people knew about us. But now that we've got, you know, a white paper from Ernst & Young, as well as Harvard Business School and MIT Sloan, statistically proving that the numbers are better and it's widely available, why not take the better number? Why not work with a better, safer number? You know, for some folks, you have a fiduciary responsibility to at least take into account the better number, especially if it's proven that way. And so, yeah, you know, a lot of things are really expensive. We do have a bunch of stocks we think are actually really nice and cheap based on core earnings.
Let's talk about stocks.
But I do think, like I'm hearing a lot of people say, we got to rotate out of some of these really expensive tech names, especially, and it's not just the tech, it's mostly their tech, but they're also just the firms that happen to have large allocations in the popular ETFs. And as part of the passive trading strategy and the crowded nature of that trade, so much money is just flowing blindly into those that it in turn flows blindly into these popular stocks. Yeah. And they're really, I think they're right. I think Dennis is right. They're topped out. You want to be selling out of those into the names that still have value.
All right. So there are some stocks that you think are not super expensive based on core earnings, and therefore there is an opportunity here. Let's talk about some of those stocks.
Yeah, I think to pick up on the bank theme you guys were just talking about, and one of the stocks, we call this the see through the dip stocks, and these are stocks that we think are extremely attractive as long as you believe that we make it through COVID in a reasonable amount of time. Okay. And that means within the next 5 years, right? So anything sooner than that could be a real positive. In addition to that, they all have valuations that imply that within 10 years, they won't be as profitable as they were 5+ years ago. Some of them 10 years ago. So they're trading as if the current profit decline related to COVID is permanent. All right, I've already made a strong case as to why it's not going to be permanently as bad as it is right now, for sure.
So, such as who?
JP Morgan is one of our favorite ones, and all of these stocks on this list happen to be best-in-class operators. So they're the highest return on capital, highest margin businesses. We think they're going to take share from the firms that don't survive. So they're going to come out of COVID even stronger than they went into it. Another one is Southwest Airlines, right? And I think it's hard to argue that the airline business won't be the same after this. But when we first recommended Southwest, it was trading as if its profits were never going to get back to where they were back in 2013 and 14. And we think that that's probably just overly pessimistic. And this is by far the best operator. I don't know about you, but I'm seeing ads all over the internet whenever I'm even on my phone about how cheap flights are on Southwest. They're going to take market share coming out of this because they can afford to deal with lower capacity utilization and lower margins better than any of the other carriers because they're the best in class operator. So those are two examples right there of big name stocks that aren't popular plays in the ETF world, but we think are going to be great medium and long-term plays in a COVID world.
Southwest reports next Thursday, so everyone have that on your radar if you're going to trade this thing. What about, I'm going through a couple more here. What about DR Horton, DHI? We've talked a little bit about the home builders, but not too much, and they're on your list as a stock that is trading as if it's going to be punished forever.
Well, if you look at your chart right here, we made the call around in late March. So you've seen it's already come back a lot. That was a great example of just one that was, a baby getting thrown out with the bathwater. They're very well diversified. They're moving into sort of lower income homes where there's more, I don't want to say low income, but not McMansions as much as everybody else. And so there's more long-term growth opportunity there. For those guys, and they were trading back in the March days. They were trading as if their profits were going to be permanently lower, as low as they were like 10 years ago. So it was just that one was, I think it was more dentist style, right? Like buy the dip there as opposed to just looking at core earnings, and in which case both of those worked and lined up really well right there. But yeah, I mean it's come back a lot, so it still's got upside, and the home building business in a lot of the world was really not hurt that much. It was deemed an essential activity. And I think our supply ratio, we got a great chart in there that shows that sort of the supply of homes is still not anywhere near where it was during the financial crisis. So there's still plenty of room for best-in-class operators to grow.
David, what about this thought with the home builders there too? And I've been talking to some real estate agents, and they're saying, in the cities, you're starting to see just from COVID this, move where some people aren't liking to live in apartment buildings as much as they used to. And it only takes a few people, we're not saying everybody doesn't like living in apartment buildings, but let's just say 5% of people decide after this, with this pandemic thing, maybe it would really suck right now to, have been in a lockdown in an apartment building versus a home. Do you think some people, that maybe live in apartment buildings might eventually look at this and say, maybe I want to move to a home? Like, could this change, some perception of, say, 5% of the population? Because that would be a really good news for the home builders.
Oh, I think it's absolutely happening in the big cities. There's massive fleeing of the cities. I mean, I've got friends that live in the suburbs of Manhattan area, and houses are being bought sight unseen in, Southern Connecticut and the New York State suburbs. You guys are in that area. I mean, people are dying to get out of Manhattan. I mean, look, as a guy who lived in Manhattan, I loved it. But I'm telling you, if if I were having to sort of weigh whether or not I wanted to deal with the potential risk of living in a city where things are just so crowded and the subway is so essential, but such a magnifier of potential disease and infection, I think I'd be getting out too. And so I think we're seeing that. We're seeing that in the California areas. Look, I live in Nashville, and so we've got all kinds of folks wanting to move here. I mean, and we can't blame them. Because it's a lower cost and higher quality of living. Now, unfortunately, I think that trade is full. We've had so many people move here, so it's not a play anymore. But yeah, I mean, I just, a lot of friends of mine up in there in the city or even in the suburbs about commuting in, just kind of said, man, I'm not doing that anymore. I'm not going to the city. I don't want to live in the city. And I think you're right, Dennis. Like, all you need is a little bit on the margin, of people leaving, and it's kind of already been happening for a long time. Like, in my opinion, like New York is so different than it was when I was there because, younger people can't afford to really live in the city anymore. And it's kind of been taken over by international millionaires and billionaires just looking to buy up real estate. And it just doesn't have the same vibe. And if you don't have that feel, it makes it really hard to stomach sort of the more challenging parts of being in New York, like the subway and the smells and the crowded and all that stuff.
I would argue that's part of the charm, but hey, David, there's a couple more stocks. You sent us a list, and for our listeners, you can find this list by going to a site, newconstructs.com. I'm just in the research tab on that site, and there's a bunch of posts here, and there's a list of stocks. You also like these are names that have been beaten down. Stocks that would benefit from a reopening, but have been beaten down hard. Darden Restaurants, Cisco, Hyatt Hotels, Omnicom. I mentioned Southwest already. Simon Property Group. Those are 5 names really beaten down stocks, beaten down businesses that you like here.
Yeah, I mean, it's all the same theme. They're trading as if profits won't be as high as they were 5 to 10 years ago, and we just think we're going to come through COVID. And in the current environment where we've seen cities have to roll back reopenings, et cetera, the sentiment just pushes stuff down as if this is sort of a permanent feature of life on Earth. And we don't think it's permanent. We think there'll be a vaccine. We think there'll be herd immunity. We think there'll be combinations of those two things. We think that healthcare will allow us to live the kind of lives we're used to living, and people are going to get back to living the way they used to live. And as long as that happens within the next 10 years, these stocks are really cheap.
I should clarify, Cisco was SYY, not CSCO, the food company, not the tech company. David Traynor is the founder and CEO of New Constructs. As I mentioned, you can learn more at their site, newconstructs.com. It's where I'm reading off a list of stocks that they like for earnings. David, thank you so much for the time, and stay safe out there.
All right. Thanks for having me.
Thanks, Dave.
All right. 853. Let's do a couple stocks from the chat. We were asked a while ago about Tesla. I haven't talked it so much today. Not sure what else there is to say. It's sort of, I don't know if Tesla correlates to anything.
It doesn't.
Yeah.
It was for a while though. It was leading tech. Now, is that going to happen today too? Maybe. This is not, you know what? Tesla, is it a reopening play? Is it a lockdown play? I mean,
I don't know what
it was being loved no matter what.
I don't know.
It really, I would think it's a reopening play. Just logically speaking, obviously, people, that are sitting want to get out, and I would think it's reopening play, but then you could argue, well, maybe it's not because people want a fancy car to drive around in when they're not doing their other things. So you're right. Tesla typically just doesn't correlate to almost anything, but it has, as of late, been leading the NASDAQ. Now, is that going to happen today? We're up 25 points on Tesla. It's getting a nice bounce. Is this the kind of stock that directly benefits from the vaccine? Not like these other reopening stocks. So I just say yesterday's high, 1590, very important. What does it do there? I still think you had the blow off top at 1794. So I think there's some work to do before you can potentially get back to there. I mean, think about Workhorse. Not that these stocks have, anything, obviously Tesla's best in breed, but Workhorse had the blow off top. And, it's been hanging out here for 5, 6, 7 days now, trying to figure out where it wants to go. And you got a real battle between the bulls and the bears here now on WKHS. So I think that's what Tesla's got to do too. I think it's going to battle in the 1500s for a while. But the buy the dipper is saying we're eventually going to 2,000, 3,000, 4,000. And then you've got, other people like myself saying that was a blow off top. and maybe we got some work back. Maybe we're going to shake some more people out. I don't know where Tesla's going long term. Obviously, valuations always kept me out, but I can say this is just a storied stock, and it's still the leader in electric cars, and obviously their story isn't going away. So it could cool off for a few days, but the story's not going away. And if it starts going into indexes and starts become a major component in all these other ETFs, you could see the argument whether Tesla could actually continue to go higher just for ETF reasons. So I think, on a significant pullback, but right now it's a curveball. I'd use yesterday's range, 1431. You get down near there, maybe you're looking to buy. If you get up near 1590, I think you're looking to sell. That's short-term trading.
If you were trading Disney last spring, you remember the impact that Disney Plus had on the stock.
Yeah.
Comcast has their answer that's going live today. Peacock, today is the first day of that. You're not seeing as much of an impact on Comcast. Is a way more diversified business than Disney when it comes to content.
Yeah.
But it's probably notable. I don't know how much impact. It's not having much of an impact yet on the stock. Not to say it couldn't, but it does have a catalyst. We'll say that.
Yeah, Mitch pointed this out. I'm long Comcast, full disclosure, because I thought that this catalyst might, kickstart it, but it's not the case. It's not getting kickstarted here this morning, so we'll see as the day goes on. But right now, Comcast is showing some absolutely terrible relative weakness. So maybe it's a, buy yesterday type trade when the stock rallied up and then sell on news. Or maybe, get some life if, they start to talk about it more in the major media. But yeah, Peacock launches today, but we're not seeing that Disney Plus type move in Comcast.
We are not. Hey, here's one we haven't looked at for at least a week. Beyond Meat.
I had it overnight. I sold it at 1:30 in the pre-market this morning, just for an overnight trade. You got the little low 125, 27, 125, 88. You get up near 2 days highs, 136, 137, 140. So there's major resistance up between 135 and 140, which makes it a tougher trade here now. But you do have that 125's major support too. So I'd say lower 125s, maybe you're looking at it. It breaches that, then you get the hell out. But I think this is more of a sell the rip opportunity. Not so much at 129, but if it was to get up to like 135, 136, I think the easy money's been made in Beyond Meat. It also has an ugly head and shoulders that has formed here now. So just from a technical basis, I don't love this chart.
I'm going through the chat, trying to catch a few more tickers. Someone's asking Dennis how high you think Moderna will go. I don't know if you can answer that or if you even have an answer for that.
No, I think it already went. What's the pre-market high? I think we already saw it.
Let me figure it out for you. What do we get to? 90, 91, 92?
Yeah, I think that's safe.
92.
And that actually, and Moderna obviously was trading, as high as $87 back. And if we just go, to the charts there, I'm going back in the gap up back in early May. So now that becomes major resistance. Can it get above 87 or does it fail there again? Again, these vaccine plays and these, therapy plays have typically been sell on news events, although Novavax is starting to show life here again too. So they didn't hit it as hard as some of these other ones. So I book profits into these events, but 87 is huge for it. So can it get above 87? Because then it starts to get interesting again. I'm not chasing it this morning though.
We're at 86 and change right now. All right, we'll do one more fast here. I saw PayPal. Let's look at PayPal.
That's going to probably be weaker here today. So that is more of a play on lockdown. It's been running because people are buying more stuff online using PayPal online. I wouldn't be surprised if PYPL goes red here today. It's holding green slightly in the pre-market, but I wouldn't want to own this stock for today. If it dipped significantly, I love PayPal, love the business. If I was long in my long-term account, I would probably still hold on to it. I still regret selling PayPal. I sold it way back in the day. I had it from an eBay spinoff, and I sold it years ago, and I wish I would have never sold it. It's a stock that I always want to put back in my long-term portfolio, and I never did. So love the business, love the stock. Significant pullbacks, I would be a buyer. Significant pullbacks being down like 140, I would be a buyer. But I think as a day trade here, I would not want to be buying PayPal this morning. This is the kind of stock that could actually get hit. unless the rotation swings back. I mean, if all these stocks, American Airlines and all them open up and start tanking again, then you got to watch the rotation because it can change intraday too. And obviously we're not with you all day. We're not talking with you guys all day. Watch the rotation. Boeing again will be one of your leaders of reopening. If Boeing opens and starts running higher, then you can say the reopening trade is strong. If Boeing opens at like 186.5 and starts tanking down to 184, 183, 182, then you could say, oh, well, we might rotate back into some of those tech names. But money is right at this time rotating out of tech and into the reopening stocks. And you can clearly see that QQQ up 0.5%, IWM up 3.1%. So you can see the rotation clearly there.
Yeah. That's something we should mention is you did, but their rotation can flip like that.
It can flip so quickly. And, you know, you've got to be aware and you've got to look at those leaders to really give you a feel for the rotation. Yeah. I've used Boeing as a rotation indicator for a long time. Like I've been saying, I've been using Tesla for an indicator on tech, although I don't know if that's going to apply as much today. It's been working well. It worked well on the sell-off on Tesla 2-3 days ago because it led most of the other tech stocks. But there's not a hard relationship there. It's been a relationship I've noticed for the last few days. Relationships change. And if you can identify them early, there's no algos that are programmed for that. You can obviously exploit the inefficiencies of that relationship if you can notice it early.
All right. That'll be a wrap of today's show. You can always catch the replay of it on YouTube or catch our podcast on every major podcast platform. Thanks to our guest, David Traynor. Thanks to all of you in our chats on YouTube, on premarket.benzinga.com, or even our new page, benzinga.com/premarket-prep, and also all of you on Benzinga Pro. Speaking of Benzinga Pro, there's a link in the description of this video. You can go to that link, get a free trial and subsequent discount to Benzinga Pro should you choose to subscribe. You can always email us, premarket@benzinga.com. Send us your feedback, good, bad, or otherwise. We appreciate it as always. And please remember that all the information from our show is meant to be used as informational purposes, not for investing or trading advice. Also, smash that like button. We appreciate the likes. I'm counting likes now. That's what my life has come to. I'm counting likes. So we appreciate that. I appreciate that. Hit that like button. Thank you very much. Everyone have a good rest of your Wednesday. We'll be back with Jason Raznick as our guest tomorrow at 8 a.m. In the meantime, everyone have a good rest of your day and stay safe.